Hello there, everyone. Today I want to talk about a effective and simple way to profit, right? That's kind of what we're all looking for. So there at Stock Market Jobber, we talk a lot about market principles. We don't worry about esoteric mumbo jumbo. But a very important market principle to understand is this: overbought markets that get to resistance tend to sell off. Oversold markets that get to support tend to rally. Now, what is resistance? Resistance is a level where there's a large concentration of sell orders. So if a market's moving higher, let me get my little flash pen here, my laser pointer. If a market, this is Taiwan Semi going back 3 years, and this just happened to be the first stock I looked at today. You can see these principles on pretty much any stock or any market. When a market's moving higher like this, there's not enough sellers around to fill all the demand that the buyers have. In other words, buyers want to buy, but there's just not enough shares for sale, so the buyers need to be willing to pay a premium. That entices the sellers to come back into the market. So that forces us into an uptrend. Now, when we get to resistance is a level where there's a lot of investors looking to sell. There's more supply than demand. So this is why markets stop going higher when they get to resistance. Sometimes they reverse, sometimes they pause before moving higher, but when we get to resistance, we tend to sell off. Okay. Now, when a market's moving lower, it's because there's not enough demand to take in all of the supply, so the sellers are forced to offer their shares out at a discount, and this pushes the stock into a downtrend. When we get to a support level, well, there's enough demand or enough buyers to take in all of the supply. As a matter of fact, there's more demand than there is supply. So this is why markets stop moving lower when they get to support. So what is overbought and oversold? Well, the vast majority of the time, a market is going to be, or a market or a stock or a crypto or whatever it is that you're looking at, is going to be in what would be its typical or normal or historical trading range. If we get above that, if it gets aggressively bought, we call that overbought. If it gets below that range, we call that oversold. Now, this is important because these conditions draw buyers and sellers into the market because they're expecting a reversion. A lot of Wall Street trading models are built on this concept of reversion to the mean. Now, here I have these Bollinger Bands, right? There's a lot of different ways to measure momentum. And momentum is overbought and oversold are terms that refer to momentum. Momentum is how far something has moved from time period A to time period B. It's not the same as volatility. It's if something gets to an extreme in a short amount of time period, well, it could be overbought or oversold. Now, these Bollinger Bands are very popular and they're very simple, and I like using them. There's a lot of different ways to measure momentum. My advice to people is just pick two or three and get really comfortable with them. There's literally dozens, if not hundreds. So Bollinger Bands, the red band on the top is two standard deviations above the 20-day moving average, and the red band on the bottom is 20 days, two standard deviations below the 20-day moving average. Now, why is this important? Well, the statistics tell us that 95% of trading should be within two standard deviations of the mean. So if we exceed that threshold, on the upside, it's going to draw sellers into the market, expecting a reversion. And if we exceed it on the downside, it's going to draw buyers into the market who are expecting a reversion, which in that case would be a move higher. So when we get to resistance and we get overbought, we tend to sell off. So here, what happens? We get outside of the Bollinger Band and we get to this level that had been resistance. Okay, so what is resistance? It's a large group of sellers. What do overbought conditions do? It draws sellers into the market. So you got this kind of double whammy. So overbought markets that get to resistance tend to sell off, and you can see it happen down here too. On the opposite side, oversold markets that get to support tend to bounce. Oversold conditions draw buyers into the market who are expecting a reversion. A support level is a large group of buyers, so you got the double whammy there on the downside. You got to a level where there's going to be a lot of buying. Now, how could you know that this was going to be a support level? Well, notice how it was a resistance level. Levels that were resistance can turn into support. It happens all the time, and it happens because of seller's remorse. There are people who sold back here who thought they made the right decision when the market went lower, but when it went higher, they tell themselves, man, I made a mistake. If I can buy my shares back at the same price that I sold them for, I'm going to. So they place their buy orders at the level that was resistance. So if you have enough remorseful sellers placing buy orders at a former resistance level, it can turn into support. And we can see that's kind of what's going on now. So let's look at a shorter term chart of the same stock. And we could see these principles here. Support, I'm sorry, resistance turns into support. Seller's remorse. People sold here. They regret doing so. Now, a lot of them are trying to buy their shares back around the same price that they sold at, around $83. You can see we're below the lower Bollinger Band, so that means we're oversold. So oversold at support, there's a good chance that this stock bounces. So right here, we got overbought, and we got to resistance, and then we sold off. It took a couple of weeks here, but it did happen. So just remember that, everybody. Very simple concept, but very effective and very efficient and very profitable. Overbought markets that get to resistance tend to sell off. Oversold markets that get to support tend to bounce. Thank you, and I hope to see you soon.